I'm here today with Ben McKeown, Investment Director at Dowgate Capital, who works on the wealth management side. Ben, many thanks for joining us.
Hi, Tabitha. Thanks for having me.
Can you tell us a little bit about your background and how you got involved in wealth management?
Well, I actually started my career at Killik in 2008 in the depths of the financial crisis. So it was a really interesting time to get a job. I really wanted to be on the sell side. I thought being a broker was sounded so cool. Following my dad and other people I knew in the industry, and I remember interviewing all over the place to try and get a job, and it was just really tough. So I fell into it. I completely fell into wealth management, really. And I went from Killik onto Hargreave Hale, and then we got taken over by Canaccord in late 2017. And it was in December last year. I left to join Dowgate Wealth with another colleague of mine, Shane, and fortunately a group of 8 others have followed since, which is lovely.
And tell us a bit about Dowgate and what appealed to you about joining Dowgate.
Well, the whole industry is consolidating, and we're a group of relatively young guys for the industry, and we just wanted to do things a little bit differently. So the typical wealth model is to have a central investment process who prescribe maybe a selection of funds or stocks that a manager can choose to invest for their clients. But we felt really strongly that, look, if you hire great people and you put your heads together, you can take a more of a bottom-up approach and bespoke, active approach to investing client money. And if you can do all this effectively, we think you can generate great returns. So this kind of allows us the flexibility to build portfolios that are more bespoke and invest client money directly into equities. On top of all this, we're launching a fund later this year, which will be sort of a UK all-cap growth fund.
So when you first take on client money, do you do it top-down, so work out sort of assets, geographies and sectors that you want to invest in, or is it all bottom-up?
We try our very best to be bottom-up investors, but and a lot of the best companies in the world, are very diversified geographically. But that said, there's lots of parts of the world we don't profess to have, any working knowledge of. We can't meet companies. We don't have access to management. Latin America, China and India and Southeast Asia, all these economies have great long-term characteristics. But, we might, to get access to these regions where it's appropriate for investors, we might just buy an ETF or just outsource to a good fund manager.
And what about asset classes and investing across beyond just company stocks?
Asset allocation, I think, is comes down to risk. And so, I think personally, for someone with a 10-year plus time horizon and happy to allow for market fluctuations, I think the majority of the capital should be invested in equities. Some people disagree, but that's my view. But in order to reduce the volatility for lower risk portfolios and clients with shorter term time horizons, you do need to have a good spread of different asset classes, alternatives, bonds, which I think just helps lower the correlations between your investments and generate a smoother return. But I do think that is a question of risk rather than for an individual client. So we try to manage bespoke portfolios. And we want to take that into consideration when we're meeting and putting them together for clients.
So what percentage would be held in company stocks as against other assets?
Yeah, so it just depends completely on the client's risk. But like I said, it can be if we can have a high risk portfolio, we might have 70 or 80% of their portfolio invested directly in individual stocks, and then we may have the balance or the remainder in high quality funds or, ETFs, and other investments to get exposure to areas of the market we don't have any expertise. And, that percentage in equities goes down from 100, right down to sort of 50 and 40% where, those are our sort of lower risk portfolios. But, people tend to come to us, we've had a Hargreave Hale with background in smaller companies and growth companies. So people tend to come to us for, the excitement rather than the medium and lower risk ends of the portfolio, of their own portfolio, if that makes sense.
So in terms of stock picking, in terms of company selections, what criteria do you use, both quantitative and qualitative?
For individual stocks, I think we want to invest in, attractively valued, really high quality companies that are seeing, the fundamentals of their business accelerate. Normally just their earnings and cash flow. So, we really like founder-led companies. We like, where management teams own significant amount of equity. Ideally they've paid for with their own cash or sweat. And we like to see high margins. We like to see innovation. Long growth runways. Maybe where a company's been really successful in one, area or niche, and they can then land and expand into other areas. These types of characteristics are the types, the ones that give us the confidence to hold these companies for long periods of time. So if the management teams behave like owners, you can invest alongside them for the long term, and that's the ideal investment, for us.
So give us some examples.
One that we've held for a long period of time, I think, which is probably a good place to start, is something like is a company called Alpha FX. So this is a founder-led business, run by a chap called Morgan Tilbrook, and the company listed in 2017 at £1.94, £1.96, I believe, and the shares are now £14. But this is a classic example of a company that has been really successful in one area and is now expanding into other areas. I mean, when we first invested it, the market cap was 50 million, and it just sold FX solutions to UK corporates. But the founder's very charismatic. Had a very tech-heavy approach. Had a very strong sales team, a great culture. We clearly read the kind of Netflix employee handbook, cover to cover. And from there they've expanded their geographical reach, and product offering into other areas like forwards and payments. And I think the long-term story is that with open banking regulations and PSD2, it's massively eroded the barriers for the banks have had in this space, which do up to 90% of the volume in foreign exchange and payments. And it's a great opportunity for young, tech-enabled offerings like Alpha to come in and take share. I guess it's just like how some of the neobanks have done in the consumer space, like Revolut and Starling Bank, which have these huge valuations in the private markets. And I think the difference is Alpha is that corporate banking is just a lot more lucrative. There isn't as much competition in the corporate space. Big banks have dominated it for so long, and you need a great sales presence as long as just good tech. So for that, the shares had a bit of a wobble earlier in the year when they couldn't, one customer couldn't pay in the depths of COVID, but it wasn't because they do have to do a lot of credit profiling on their customers. But it was just a delayed payment rather than a missed payment. And they have a great track record of growth, and given that they're not expensive, given the forecast and the opportunity, the long term opportunity they've got. So that's the type of company that we want to hold. We bought it at IPO and we still own today.
The valuation on Alpha FX, it gets steeper and steeper as the company proves itself. Is there a point at which you find something gets overvalued, and even though you still like it as much, you have to sell it on valuation grounds?
No, I think we try not to take valuation into consideration when it comes to, apart from the initial buy decision. But I think, you do find that, as good companies, prove themselves to the market, the valuation as well as their earnings go up. So I think that's a challenge. You can't just sell a company because it's too expensive, because usually the market has got it right, and it's re-rated in advance of future earnings growth. And I think in Alpha's case, the valuation has got steeper more recently, but I guess there has been one or two examples where the valuation has come down. And I think one of the ways I justify it today is that historically they've had a big percentage of their revenues come from their forward FX book. And more, they're doing more spot business, which is more cash generative. So you're seeing a lot more of cash conversion come through to the bottom line. And I think that, plus re-acceleration of growth post-COVID, I think there's an argument to say that the valuation could accelerate further, as you get no need for any more fundraisers like they've had a couple in the past, and there's that much more cash generative nature of their business and stickier business, given their kind of more tech-enabled offering in payment solutions.
Do you have another example?
I was going to say something that we bought recently, because Alpha we've owned for many years, which was a recent listing on the London Stock Exchange called the Hut Group, which listed in September last year. And we just thought this is a really interesting and unique e-commerce play. It's not a small cap, but in 2010, while they were actually still private, they acquired Look Fantastic, which is a leading online beauty retailer. And the cosmetic industry, prior to COVID, was relatively underpenetrated online. Customers like to try products on the ground floor of a department store. But the economics, I think, work really well online. The products are high value, they fit through a letterbox, and very high margins. So I think COVID and this adoption of technology has just changed how customers shop. And I think really forced people to see how much the online experience has improved. And you can see THG with their acquisitions is now going after that vertical margins in the space, by buying consumer cosmetic brands, selling them directly through their own retail channel. Not long after they acquired Look Fantastic, they acquired MyProtein, which they've done a great job at building into a leading brand in a really tough industry. So you can see they're starting to build this sort of cookie cutter approach of how to build brands online, and that's I think the real jewel in the crown. The Ingenuity platform, where they've taken their approach, their internally developed software, e-commerce platform, warehouse software, CRM platform, influencer platform, and they've bundled this all up into, sold it to other brands in return for a share of the revenue. No one's really put all these bits together, on one platform for a brand to allow them to sell direct to the consumer. I mean, if you're a small business, you might go to Shopify, but you've got to get your Shopify platform to link to your warehouse management system, your CRM system, to link to the other bits and pieces in the organization. Or you may just want to use Amazon, but they're going to want you to sell their website, or they're not going to help you with influencer marketing. So I think they've kind of delivered this one-stop shop for people. And for that reason, they've got this all-star cast of brands using them for their online capabilities, like Nestle, Coke, Kellogg's, Procter and Gamble, Microsoft, and Nintendo. It's a really class roster. And onto valuation. It's not expensive. It's an EV to sales multiple of 4 times for what could be a very high margin opportunity. And I think an interesting comp is Ocado, which I think is a lower margin opportunity, but on 7 times EV to sales. So, I think that, that kind of growth at an attractive price, is one that, is an area that we're really interested in. And I think I saw a Jefferies note, Jefferies analysts who I really rate in the sector, who thought they could make 43p of earnings in 22, which puts it on 18 times earnings, growing top line at 25%. So, I think that's something we really like now, and I think is very interesting today.
How long's your average holding period? When you buy into something, how long are you expecting to hold it?
Ideally, we want to hold these companies forever. We don't want to start, go selling our greatest shares. And one of the reasons we sell is, to top slice stocks when a holding becomes too big in a portfolio, because we don't want to have, hugely concentrated, because, equity markets are full of, you tend to get these big winners if you look for the right, types of characteristics, or when we make a mistake, or something fundamentally changes and the economics of an industry sort of, we find they're reduced, or a company itself are reduced significantly. So we have no real set holding period, but it's nice to be able to say we've owned, we bought Fevertree at the IPO in 2014. I think we still own shares today, and obviously we've top sliced them, on the way up. But we still have shares for our, from that initial IPO. And the same is true for many other great growth companies in the UK and overseas.
What sort of growth are you hoping to achieve from a holding when you buy into it?
It's difficult to say, but you ideally on a portfolio level, I think for an individual company, we want to try and make 20% a year. But think you get things wrong, and things go wrong, so you're never going to quite, that's the holy grail. And I think if you can compound at sort of 15% a year, and this is for a higher risk client, I do think you can sort of double your portfolio every 5 years, which I think is a fantastic return. But I think to get there, you do have to invest a good proportion of your assets in smaller and growing companies, which obviously can be more volatile. So, but that's our real target for our high risk portfolios, and hopefully what we can still target for our fund as well.
So you talk about the Hut Group, which is e-commerce. Which other sectors are you particularly interested in at the moment?
Well, I still think those kind of secular trends of e-commerce is one, but Fintech, cloud and gaming, they're not going away anytime soon. And I'm sure everyone says this to you, but COVID has accelerated all these trends. And I think the net result of COVID is that technology has become more ingrained in our everyday lives. So now we have a working vaccine. We're looking at ways to play the reopening, but bearing in mind we've got a more tech savvy consumer, especially the older generation. So I think online travel companies, like On the Beach, for example, are bound to see a huge surge in demand. When people can finally go away again, and these types of companies I think will likely take share.
So something like On the Beach, hasn't the valuation of these recovery plays got rather ahead of itself?
I wouldn't say ahead of itself, but the market has started to price in, our recovery because that's what markets do. They're forward pricing mechanisms, and starting to say that people will start to go away again. But I don't think the scale of the surge in demand that I think is likely to happen. And I think you could see by the time, when last year, when the government put Canary Islands onto the government's kind of travelled corridor, I think someone like EasyJet or Ryanair took about 26,000 bookings in one day. So I think there's a lot of pent-up demand. People do have some spare cash that have continued to, kept their jobs through COVID. So I think, you're almost going to see a re-acceleration to levels that you may have seen, would have seen beyond, pre-COVID levels, as people are desperate to do something, or desperate to to be allowed out as soon as we've got a working vaccine and they feel it's safe to do so.
So you referred to Fintech. Have you got any recommendations in the Fintech space?
Well, I mentioned Alpha, which is a Fintech, and I think that's a really interesting company, well worth looking at. Unfortunately, the best Fintech businesses with scale, I'd say, with the exception of probably Alpha. Apologies for any UK company I've missed, but I would say most prevalent in the US. And if you look at PayPal, for example, and Venmo and Square's Cash App, that I think the US digital payment opportunity is vast, and the US are light years behind the UK when it comes to adoption of fintech and online payments and online banking. So I think that's a big opportunity, and PayPal is a big holding of ours and has been for some time, for that very reason.
So you invest in both the US and in Europe?
Yeah, we do. Yeah, where we have access to the company management teams, either on a Zoom or conference calls, and we can do that directly. I think it's really important that we're able to invest in these companies for individual clients, and I think it helps sort of reduce the layers of fees on fees of that you can get. So if you typically go to a wealth manager and they buy your portfolio of funds, you would end up not knowing what you own, and probably they're probably charging you a number of different layers of fees to get a sort of maybe mediocre result.
So in terms of liquidity, do you find the US much more liquid than, say, the UK?
Yeah, definitely. And, and it's a great shame, but obviously there's just a bigger pool of capital in America, which goes without saying, really. But it is a really important consideration for UK companies, because they, typically, they are smaller. A small cap in the UK is sort of below $500 million, whereas anything below 10 billion in the US is a small cap, which would probably that company would probably get into the FTSE 100 in the UK. Hargreave Hale, the business, ran nearly 8 billion, and the majority of which was in UK smaller companies. So I think there becomes a point where, if you're too big and, you have too big a percentage holdings in companies, you become unable to move, as effectively as you'd like. So for that reason, we've chosen a UK all cap fund for a first fund to ensure that we've got that level of flexibility that we need. And on top of that, companies are staying private for longer because of this big pool of availability of private capital, which is a great shame.
And where do you see the future of fund management?
I think the market is polarizing massively, and you've got the people who want to take a DIY approach and go to Hargreaves Lansdown or the platforms like AJ Bell, and those people who want a trusted advisor to do it for them. And I think the typical client with a trusted advisor is unfortunately being hurt badly by, like I said, these layers of fees, platform fees, fees to the wealth manager, fees to the fund manager. And they usually pay, in my opinion, too much, and often find themselves over diversified, don't get a great deal of outperformance, over and above an index. And so I think when you look at it like that, people just say, well, you might as well buy an index. We do feel quite strongly that if you invest in great companies, you can generate great returns. And, indexes can't do that. They over-index larger companies and they under-index the smaller companies. So we do try and invest directly wherever possible for our clients, and that helps keep costs down. And I think it's really important to our success, and ability to outperform.
Brilliant. So where do people find out more about Dowgate and more about you? Well,
we're in the midst of a rebrand to a new website, but you can find us on the Dowgate website online. I'm on LinkedIn. We're launching a new fund. This year, which we like to see on some of those platforms we just mentioned, and I think that's we're hopefully going to have a very competitive charging structure, which I think will be market leading. So hopefully you'll see a bit more of us in the press coming up to that. But online or LinkedIn, feel free to drop me a line.
Tremendous, Ben. Many thanks indeed.
Thank you, Tamsin. Thank you very much for having me. It's a pleasure to be on.
And for more investor interviews like this, go to piworld.co.uk. Many thanks for listening and stay well.